revise. Principles and boundaries of financial reporting frameworks. Chapter 2: Conceptual Framework for Financial Reporting. Objective and scope of financial statements. The conceptual framework sets the stage for how financial information is prepared and presented. It moves away from just recording to focus on information that is useful for assessing an entity's future. Primary objective: to provide financial information about the entity's assets, liabilities, equity, income, and expenses. Utility for users: this data helps stakeholders assess the prospects for future net cash inflows to the entity. Management stewardship of the entity's economic resources. The entity perspective: financial statements are viewed from the perspective of the reporting entity as a whole, rather than from the perspective of any specific group of investors or creditors. Forward-looking info: forward-looking information, like management strategies, is generally not provided unless it specifically relates to assets or liabilities that existed during the reporting period and helps users understand those measures, e.g., estimated future cash flows used to value an asset. The going concern assumption: financial statements are normally prepared assuming the entity will continue in operation for the foreseeable future. The exception: if management intends to liquidate or cease trading, or has no realistic alternative, the statements must be prepared on a different basis, which must be explicitly described. The reporting entity. Definition: a reporting entity is any entity that is required, or chooses, to prepare financial statements. Legal status: a reporting entity is not necessarily a legal entity, it can be a single entity, a portion of an entity, or a group of multiple entities. Boundary determination: if the entity is not a legal entity, its boundaries are determined by the information needs of the users, ensuring the activities included are not arbitrary or incomplete. Types of statements. Standalone: separate, the parent company alone. Consolidated: both the parent and its subsidiaries treated as a single entity. Combined: two or more entities that are not linked by a parent-subsidiary relationship. Actionable next step: now that we've established the objective and the entity, are you ready to explore the qualitative characteristics, relevance, faithful representation, and prudence, or move to the elements of financial statements, defining assets and liabilities? End of episode 14.